Hello, I'm David Chaston with 9 at 9, brought to you by Interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock, with news of major official rate cuts in China. China's central bank cut interest rates over the weekend for the sixth time in less than a year, down 25 basis points to 4.35%, and it again lowered the amount of cash reserves banks must hold in a bid to keep their economy growing at the planned rate. Monetary policy easing in China is at its most aggressive since the 2008-2009 financial crisis, as growth looks certain to slip under 7%. In the same announcement, it has scrapped rules on what banks must pay savers. The change, which has been signalled for months, should allow banks to price loans according to their risk and remove a distortion to the price of credit that analysts say fuels wasteful investment in China. But these changes have had no impact on equity market sentiment anywhere. Also in China, there are major set-piece policy reviews due to take place this week. The Chinese Communist Party meets and will approve an economic plan for scaling back the role of the state over the next 5 years and give important indications about Beijing's appetite for transformative change in the face of slowing growth. And ahead of these meetings, an official paper has come out saying China should seriously consider joining the Trans-Pacific Partnership. Just how fast China is slowing is getting serious debate. Those who look only at manufacturing see plenty of signs. Those who look at the wider economy aren't so sure that it is that serious. The number of new American single-family homes sold in September fell sharply from August after 2 straight months of gains. But a jump in prices suggests that their housing demand remains on solid ground. Sales volumes are up only 2% on the same month a year earlier, but median prices were up 5% to $296,900. And here's something to watch. Ping An, the giant Chinese insurance company, was offering zero-deposit home loans for off-the-plan apartments in Melbourne and the Gold Coast, spruiking the loans to Chinese investors at a conference in Shanghai last week. There is nothing the Aussie regulators can do about this, even though it breaks their domestic rules. In fact, it even goes against the policies of the Chinese Administration for Foreign Exchange. But it could easily result in a new flood of Chinese money heading this way. In a blow for livestock farmers, the World Health Organization said overnight that processed meats do cause cancer, and that eating red meat was probably carcinogenic as well. But there was limited evidence. As a salve, they also said that eating red meat also had health benefits. The political brinkmanship surrounding the American debt ceiling is rising fast yet again as Congress attempts to push through legislation to raise the limit before November the 3rd, when all the funding tricks that the US Treasury uses will run out. Pushing back are lawmakers who have watched the federal debt levels explode under President Obama, now at $18.1 trillion. When he came into office in 2005, it was at $8.2 trillion. In New York, the US Treasury 10-year yield benchmark slipped slightly and to open the week at 2.07%, so far unaffected by the debt ceiling risk. US benchmark oil prices just slightly over $44 a barrel, with the Brent benchmark just under $48 a barrel. The gold price is unchanged at $1,167 an ounce. New Zealand dollar starts the week stronger. It is currently a little higher against the greenback at 67.9 US cents, lower against the Aussie at 93.5 Aussie cents, and up against the euro at 61.4 euro cents. The TWI is up overall to 72.7. I'm David Chaston. That was 90 at 9, brought to you by Interest.co.nz.